Hey everybody, good to be here today. My name is Brent Moores and time for managing an options portfolio. Obviously, we've had a lot of news going on over the last week or two, and that's affected the markets. It's affected the options markets, of course. And, we'll try and use that hopefully to our advantage in our options portfolio. We'll get to that in just a minute. I'm glad you're here, though. I see some familiar names. Also, a familiar name there in the chat is Connie Hill, who's helping me out. She's a colleague of mine. I've been working with her for many, many years, a couple decades actually. And just glad, as you have questions, feel free to put those in the chat between Connie and myself. We'll do our best. Also, you can follow Connie or myself on X. We both post content throughout the week related to the financial markets that I think you may find helpful. So X handles. Mine is at Brent Moore CS. Connie's is at Connie Hill CS. Okay, before we get into this though, I need to go through some disclosures. One, options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs, and short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Rolling strategies, they don't save you on commissions. So just realize you can put it all in one ticket, but you still have the commissions and fees involved. So just be aware of that. The material today is intended for general informational and educational purposes only. Paper money software application is provided for educational purposes only. Paper money is software application, which is what we'll be using, will not assign a short option early. That's different than your live account. All investing involves risk, including loss of principal. Schwab does not recommend the use of technical analysis as a sole means of investment research, and past performance is no guarantee of future results. This is the markets, down a little bit today. Obviously, we've had a pullback in the markets, a lot of that probably related to the war. We'll see, we'll see how that gets resolved. Oil prices are a big factor in the overall market right now. And oil prices have, they spiked a few days ago. They're still relatively high. They're well off the highs, but they're also well above where they were a few weeks ago. So there you go. Now, this causes some jitters in the markets. It can affect the pricing of options. That's what we call the implied volatility. Here's the implied volatility on SPX, but a more common way of looking at that is to look at the VIX itself. Let me just change that graph here. Here's the VIX. Let me switch to a 3-year chart. The VIX tells us it's a measure of implied volatilities on S&P 500 options. Another way to consider it is it's how fearful people are of the market. Let me actually just switch this to daily data, 3-year daily. And this line approximately, it's moved a little bit since I've drawn the line, but that's the approximate current value of the VIX, this white line here. And what you can see is, as you look at this, there's times where it spikes up higher, but it typically doesn't last that long. It tends to revert back to a lower level. It can spike up higher and it can stay up higher for a while, a few weeks or whatever. And we've spiked up higher, and I'm not saying it's likely to go down below 20 in the next few days, but it could. We're at about 25.6 right now on the VIX. And, it can go higher, and that's going to affect your options in one way. It can go lower, and it's going to affect your options in a different way. And so in this case, what we have is you can kind of make a trade based on which way you think it's going to go. If you think it's going to go higher, it may be more appropriate to do more like long options, long calls, long puts. Or another way of putting that is positive vega trades. Vega is that option Greek that describes how your trade is going to perform in relationship to moves in the implied volatility. Or you can take the opposite approach and say, I want to do a negative vega trade, which is probably going to be more emphasized short options, which are going to tend to benefit from drops in implied volatility. But remember, this is just one piece of the puzzle. Look, if implied volatility drops and you do a short trade, as you anticipated, but you do a bearish trade and the stock goes way up or the market goes way up, you're probably going to be losing money regardless. This is just one piece of the puzzle, but it can influence the types of trades you do. Now, over the past, we occasionally get surveys in this webcast. Don't have one out today. Who knows whether there'll be one out today or not. But in those surveys, you're given the opportunity to ask questions. And last week we did a survey and there were a few questions that different people asked. And I want to address those questions today. When you ask those questions, when you fill out those surveys, I try to, as long as it's possible, I try and get your questions answered at some point. But one of the questions was, hey, talk about covered strangles. You haven't talked about covered strangles lately. Well, let's talk about covered strangles because I think it goes right in line with this volatility narrative that we're talking about here. First of all, what is a covered strangle? Well, a covered strangle is basically a covered call and a short put, okay? A covered call and a short put, or another way to say it is it's like a short strangle where you own the stock, okay? So that's a covered strangle. So you're going to have long stock, okay? You're going to have long stock. You're going to have a short call, typically out of the money, and you're going to have a short put, typically out of the money. That's your covered strangle. The short put is going to be a negative vega trade. The short call is going to be a negative vega trade. Long stock, that's vega neutral. There's no vega to it. So do you see how if you think implied volatilities may come back down, this trade may fit the bill? Maybe not. There's more factors than the implied volatility. Look, if you think a stock you're looking at is going to go way up, you probably wouldn't do a long strangle because you're limiting your upside. If you think the stock is going to go way down, then you probably wouldn't do this trade, even if you think implied volatility is going to drop, because there's a lot of risk to the downside there. So there you go. Let's look at this. I'm going to give you an example here. Let's look at an example. And for the example, I'm just going to look at Intel. Okay, Intel is typically a fairly liquid stock with liquid options, typically, and it's one where let me pull up implied volatility. Here's implied volatility. Implied volatilities are a little bit higher, and we've got earnings coming out. Let's see, we had earnings on what day? The 22nd of January. That means we're probably going to have earnings approximately April 22nd. Do you see how I got that? I don't know exactly the day, but usually they're 3 months. So if they came out on January 22nd, January, February, March, April 22nd. Now, it may not hit it exactly, but that gives me an estimate rather than having to look it up. If I want to look it up, I can go to the Analyze tab, I can click on Earnings, and I can see earnings are out on April 23rd. Okay, that's when they're scheduled. All right, let's go back here. So I may keep that in mind, but the point is implied volatilities are relatively high right now. Usually right before earnings, they tend to go up there. But if my assumption is the market's going to settle down a little bit, we may get a little bit lower implied volatility, maybe we look to do a covered strangle on this. Let's take a look at this. So how do we do that? Well, I can buy the stock. I'm just going to click on the stock. And to be honest, I'm not sure. Is there a covered strangle in here? I'm not sure. They don't actually have something labeled covered strangle here on this, but that's okay. You can add multiple trades in. I clicked on the stock and it brought up a stock trade. Now I can go here and I'm going to go out, and we said earnings were on like April 22nd or something like that. We'll go to April 17th, and I'm going to go and I'm going to use my delta here. Okay? Delta tells us how much the option is going to move in relationship to a $1 move in the stock price. But I'm going to go here and I'm going to do something kind of like, I'm going to go to roughly a 30 delta. Okay, we'll go to 28 delta here on this. And I'm going to sell this. I'm going to hold down my control key, click on the bid price. Doesn't like that. I guess it won't let me do it that way. Okay, all right, let's do this a different way. Let me go and start with a covered stock, and let me get rid of the old trade. We're going to get rid of this. Let me just delete that order. Let's do the same thing, but we're going to go to, we said the 55 strike, and I'm going to just click on that. That brings up there, and I'm just going to see, is this going to let me do this? And let me go, and I'm going to sell a put, again, roughly the 30 delta, and I'm going to, it's not going to let me do that. Okay, well, we're going to have to add it a different way here then. Let me just think about this. I don't want an OCO. I can certainly do let me just do I think of the best way to do this here. Color, we'll just say combo, see if it does that. Okay, so we're going to do, let me just add something in here. And we're going to sell the call at the 55 strike. We're going to make it a custom. We're going to sell a put at the 44 strike is what we said. And it's not going to let me do that. Okay. Let me just, sorry, I didn't expect, let me go do this. I'm just going to do a blast all, and we're going to add in stock there. There we go. Okay. All right. So now what I can do is we have this trade. Let me go, and I'm going to put these in, and I'm going to just put that in at a market price, and I'm going to put this in at a price that is likely to get filled. Confirm and send, and we're going to send this. Okay, so we filled that. Now let's look at Intel. Okay, so analyze, risk profile. Let's look at Intel. Here's our trade. We have the underlying stock, we have a short call and a short put right here. And this is what it looks like. The current price of Intel is just a little bit below 48. So you can see right now, it's a bullish trade. We want the stock to go up. If I were just looking, if I just did the stock, if I just did that stock and looked at the delta, what's my delta on 100 shares of stock? Okay. Here's 100 delta, 100 shares of stock, 100 delta, just bullish trade, right? We start adding in, and now we add in the call. What's my new delta? My new delta is 71. How did I get that? Okay. Well, we start with 100 delta on the stock. We did a covered call, which had a delta of about 29, negative 29, minus 29. And so we end up with a delta of around 71. Well, we're then going to throw on a short put as well. And now my delta is hold on one sec. I threw on a short put, and my delta is back closer to 100 here on that. So that's our trade right now. This is slightly bullish, but because we have that stock, and it starts to cap out when we hit the 55 strike here. But here's the point. If you look at the theta, we have time decay helping us out. About $8.50 a day in time decay benefiting us. Now, as I mentioned, there's a lot of different factors in there. If the stock goes way down, it's a problem. Okay? If the stock goes way down, we can end up in a bearish situation, but in a losing position. However, right now the delta is helping us out, everything else being equal, to the tune of about $1.50 a day. Now, right now, if you look at the purple line on the graph, look at the purple line on the graph and the blue line on the graph. Keep in mind this. The purple line, that represents today's date, okay, is lower than the blue line. What does that mean? That means time decay is helping us out. Over time, this purple line would tend to go up. It gets closer to what the blue line would be. That means this is a positive theta trade. Positive theta, okay? That means time decay is helping us out. And visually, you can see that. So that's going to also take advantage of Vega. Vega is negative. Our trade would benefit from a negative move in implied volatilities. So that trade fits the bill if I want something that's kind of relatively neutral, maybe slightly bullish here, but takes advantage of time decay and a drop in implied volatility. How are we going to manage this, though? Okay, how are we going to manage this? Well, keep in mind, we want the short options to go down in price. We have a short option, a short call at 55. That's a call. We have a 44 short put. For this, if this stays out of the money, this is eventually going to go down to zero, probably. Now, there is the possibility of early assignment on these, but if they're out of the money, the odds go down of early assignment. So this could go down to zero, okay? So if the stock stays between these, that'd be just fine, okay? Furthermore, if the stock does pay a dividend, and to be honest, I'm not sure if Intel does or not. I don't think it does, but we would still receive the dividend because we own the underlying stock on that. To check if it pays a dividend, you can just go to the trade tab. You can click right here and you can look for dividend. Okay, no dividend. But this, for other stocks that you look at, that may be the case. Now, let's do this. Let's talk about closing this out. There's a question that came out in that same survey I talked about already. Remember, I try and answer your questions when I can. And the question is, when should you let an option expire worthless? Let's say we get closer to expiration on Intel. Okay, let's go to Intel. Here's Intel. Just as a reminder, we have a short call here. We have a short put here. Okay? Short call there, short put there. That's where those options are going to be. That's where if we're in between those, both of those are out of the money. Are we likely to get assigned if they're out of the money? Probably not, but it could happen. Theoretically, options can be assigned at or any time up to expiration. But when we talk about closing out options early, about letting them go to expiration and expiring worthless, one question you want to ask yourself is, what are the consequences of early assignment? Let's say we have this stock, Intel, and we do this trade, and it goes up here, and we think it's out of the money, and we get assigned early on this. What's the effect? Well, we'd lose our stock. That may not be the end of the world. That may go into your decision as to whether I want to close this out early and pay the money to buy it back. Maybe I'm down to the point where there's only 10 cents left on the trade, 10 cents left on that option value. And I'm deciding whether I want to buy it back, spend that money, or just let it go of the extra few days and let it get assigned, let it expire worthless, probably, not knowing for sure. Think of the consequences of letting it get assigned early. Let's say the stock's down here, and the option is mostly worthless. It's out of the money, but I want to reduce that risk because with the short put, I'm on the hook to buy more stock if I get assigned, and I really don't want to buy more stock. Then I may pay the extra money to buy it back, even though if I wait just a few days, it's probably going to expire worthless. So if you have a short option, to me, that's the biggest factor. What are the consequences of an early assignment? And also, what else are you going to do with that money? As long as you have that short option out there, it's taking up some of your buying power. It's taking up some of what you could allocate that money to for future trades. Those are the biggest considerations on buying back these short options early. What about long options? When would I sell a long option versus letting it just go, letting it go to expiration? Well, really, it's how much benefit you have. How much is there anything left, any value left in selling this option? If it's practically worthless, and we'll see an example of this in just a little bit as we look at other trades. If it's practically worthless, we may let it run just in the unlikely chance the stock all of a sudden flips and goes our way and makes it worth something. So think of the odds of assignment on these, the odds of early assignment. We never know what they are, but the more in the money they are, the higher they are. And if they're out of the money, they're less likely, but it is possible. Okay. So think of those considerations and what the benefit is. And then you can decide whether you want to get out of those early. So we'll see some examples of this. All right. Let's take a look, though, at some different trades here. I'm going to go down to, let me start with unallocated. We just added this Intel trade in here, so I'm not even going to look at this right now. But let's look at NVIDIA. NVIDIA looks like 100 shares of stock. I have a note on here. And someone earlier asked me about a wheel strategy, okay? So could we have done a wheel strategy on We could have done a wheel strategy. What's a wheel strategy? A wheel strategy is where you usually start with the short put. That's what we did on this. And then if the short put gets assigned, we end up owning the stock, which is where we currently sit. and then we add a short call to sell that call at a higher strike if it works out that way. Okay, so that's what we're going to do. We sold the put, we got to sign the stock. Now we're going to look to sell the call on this. So let's look at NVIDIA, and we'll just look at the chart here on NVIDIA, and I'm going to look to sell a call. Maybe something up above kind of where our highs have been. We had some resistance around that 194, 195 level. Maybe that would be an area to look to sell that. So I'm going to go out here, and I'm going to go out, we'll go out about 30 days here on this, about a month. NVIDIA options are typically fairly liquid. And I'm going to go out roughly a 30 delta. I can go to the 195 and get a bigger premium here. And I'm going to sell that. $440. $440 I get if I agree to sell my stock at 195. Okay. So what I'm saying is I bought the stock. I'm agreeing to sell it up here if it does go up here. From a technical standpoint, if it does go up here, there's certainly a chance it kind of bounces down anyway there. But I'm agreeing to sell it for 195, and for that, I'm getting paid 400 and what do we say, 30 bucks? So that's what we're doing. So this is the wheel strategy. This is the continuation of that wheel strategy. So I'm going to go to that 195, something in the ballpark of a 30 delta. I'm going to click on the bid price on that, and just going to move that so I can make sure I get filled on that. And I'm going to confirm and send. Make sure you read this. This is going to create a covered call. I already own the stock at this point. I'm going to create that covered call there. And now, if we look down here, well, it didn't fill yet. Come on. Just going to push this to fill. There we go. And now we should have that covered call down there. Okay. In terms of management of this, if this goes in the money, no problem. We're not going to look to buy back the call. This is the wheel strategy. If we get assigned on this and the stock goes above or probably close to 195, that's fine. We'll just look to we'll lose the stock, but then we'll look to sell a put at that point. That's the wheel strategy. Let's say this, in the very rare circumstance, this is out of the money and I got assigned early. Let's say the stock's at 192 and I got assigned early. You know what that's telling me? That tells me someone's buying the stock from me for $195. I'm okay with that. That's not a problem if I'm out of the money and they decide to assign it early. I don't think that's a problem necessarily. All right, so that's NVIDIA. That's how we're going to do that. Let's look at another one. We have ExxonMobil. It did this trade not long ago. Let's take a look at, make it a little easier for you to see here. What do we got here? Well, this was kind of an iron condor, right? But we just have an unequal number of contracts on this. So it's just unbalanced. We have more put contracts than call contracts. The current price on it is a little bit above $150. We want the stock to stay between 170 and 150. We can kind of manage these separately if I want, the two vertical spreads here. The call side is doing fine. That's not a surprise because we're a ways away from that. The put side, we're down $8 on it. Overall, we're doing okay on the trade. So if you're wondering, like, where do I want this stock to go? Take advantage of the Analyze tab. Here's the Analyze tab on, I don't want NVIDIA, I want ExxonMobil. Okay. And here's where the stock is right now. Right here. If the stock goes up this direction, we're in pretty good shape for a while. Eventually it gets bad, But that's up a ways. That's like at 177 where that really turns problematic. If it goes down, it can go down fairly quickly. So basically, I want to still be bullish on this, because if I'm not bullish on this, there's this risk sitting and it's not that far away. I just want to get out of that because I can get out of the put side. Well, I can get out of the whole thing right now for a profit, probably. I can get out of the put side with a small loss. So am I still bullish on ExxonMobil? Yeah, I'm going to call this. I'm going to say this is still bullish because I'm going to say the support level is still intact. If we break below that support level, maybe I want to get out. So we can look. I've got an order on this, and let's look and see what our do I have it marked here? I didn't mark it. Normally I'll put a note on that. ExxonMobil, we're getting out if the stock goes below 145. Okay, so if it turns bearish on us, we're going to get out anyway on that. So for that reason, I'm going to let this sit. Our theta is positive right now, close to $5 a day benefit on this. We're still bullish, still 37 days. We're going to let this do its work. Okay. Any questions on that? Why we're staying in? Now, I could look to get out of the call side if I've made almost all of what I can make, but I still have quite a bit to go. I still have like almost 60 cents or $60 for the contract on the call side that I can still make. So there's still a fair amount. There's still some meat on that bone, so to speak, on the call side of the contract. So that's why we're going to stick with ExxonMobil here on that. Okay, let's look at some different types of trades. Let's go to Micron. What do we have on Micron? Well, I have a butterfly spread. It's a little skewed though. Okay, do you see what I mean by skewed? The difference between the middle strike of the butterfly, those are the short contracts right there, and the high side, that's a $20 difference there. Okay. The difference between the middle and the low side is $30. Just a slight, and what that does is, since there's a bigger gap on the lower side, it makes it bullish. Okay, it makes it bullish. If you get confused on these, that's why you have the Analyze tab. If you're going to use the Analyze tab, just click on it, pull up the stock, Micron. Make sure, this is a common error on this, make sure you don't have any other simulated trades lingering down here, because that'll mess it up. It'll mess up what it looks like, but I don't. Okay. And I'm going to look at this. Here's my current price. By the way, you may have a slice that's like somewhere else that's not on the current price. Just, you can unlock it and make sure it says 0 there. And that'll be the current price. Or you can always add a new slice. That'll add it to the current. That's the current price. What's my risk to the upside? Well, the upside doesn't look bad, does it? Because even if it goes way up, still looking profitable on that risk profile graph. And this is just an estimation of prices. It's not an exact guarantee of what prices are going to be. Just keep that in mind. But the reality is there's not that much downside for an upward move. Keep in mind, we can be assigned early on those options. If the stock goes down, it can get us in trouble here. But you know what? It's kind of a moot point, because one of the rules that we typically use in this webcast is we close it out when we get closer to expiration, under 10 days to go to expiration. Now, an exception to that, I would say, is if we're doing a short-term butterfly or short-term trade, that we only opened 3 days ago or something like that, we may not get out exactly under, right when it gets under 10 days. This has been in place since February 18th, so not quite a month, but good 3 weeks here. So here's what I'm going to do. I'm just going to get out of this. Yes, we can make more on this trade, but I'm going to follow our rules. this has 4 different contracts on this. I'm not going to try and get out of the whole thing at once. I can, but I'm likely to get better pricing if I go one side at a time. Remember, on a butterfly, you have a short call vertical and a short call vertical and a long call vertical. I can go here, highlight them, right click, create a closing order, and just get out of the vertical, that one vertical. Okay. Firm and send, send. Now I'm out of that. I'm left with the other vertical now. I'm going to get out of that vertical now. Okay. And I'm going to right click on it, create a closing order, send it. Sometimes it can be hard to get good prices when you're trying to get out of one of these 4-leg type trades. Okay. So there we go. Now, let's do another one that's similar, except not profitable. Okay. Here's one that's not profitable. Procter & Gamble. This is one we got in. Again, a butterfly. Again, an unbalanced butterfly. Look, we got in on the 27th. Let's look at the 27th on Procter & Gamble and see what happened to us. This was kind of a neutral to bullish trade. We got in right here. Let's see, 27. We got in right here. Talk about perfectly bad timing on this. We got in on a neutral to bullish trade right here, and then it just kind of fell through the floor. So it went south on this. Now, the question is, we're under 10 days to go to expiration. Should we just get out? Well, one consideration could be let's look at that Analyze tab here for a sec. So I'm going to Analyze in Procter & Gamble. This is where we currently are, right here. Notice, what's our max loss on this trade? According to this Analyze tab, $173. You can see that right here in the blue, minus 173. That's basically as bad as it gets. Let's look at the current value on this. Procter & Gamble. We're down basically $170 on this. In other words, we've lost almost it's not going to get much worse. Now, there still is the chance of early assignment. Keep in mind, these are calls. And to get up there would require a pretty big move up in the stock, which would benefit us. So even though typically we're going to get out if we're under 10 days to go to expiration, it's going back to one of those things I said earlier of deciding when would we let it go to expiration. What's the downside on this if we continue to hold it? There's not much. It's probably not going to get a lot worse for us. Could get a little worse. It's probably not going to get a lot worse for us in this example. And therefore, for that reason, I'm going to elect to hold this. We're probably going to end up at this rate with it not getting any better. But it just doesn't harm us to hold on to that. Does that make sense, everybody? Ask a question if you have a question on that. There was a question on another one from Ted. Because I had that butterfly and I exited one vertical spread at a time. Can you exit one leg at a time? Absolutely. You absolutely can do that. And that is no problem. I kind of did it just for time's sake in a sense, but you can exit one leg at a time. One thing just to be a little cautious on if you're exiting one leg at a time is if you exit the long legs first, then you could just be left with short legs, just even if it's only taking a minute to get out of these. Depending on your options approval level, you may not be allowed to carry that short call or short put, that naked call or short put there. So if you do exit one leg at a time, more commonly you'd exit the short legs first and then the long legs there. Okay. So, Reichberg said, no assignment to the 170 short. Well, think about this. This is a call option, Reichberg. The stock is at 153. Okay. Could we be assigned early? Technically, theoretically, we could, but with the stock $17 out of the money, it's not the end of the world there on that. Okay, that's probably unlikely here in this case. Okay, I'm hoping that's making sense on that. Okay, let's move on. Let me just check time. Okay, we're running a little low on time, and I want to get to some more management, but I also want to talk about another question that came up in the survey last week. And that was, what are some actually two more questions. One was, what are considerations in buying less expensive stocks, or in our case, options on less expensive stocks? Let me just use an example here. I'm going to go to Ford because I know that's a cheap stock. Okay. Ford is $12. When you're looking at Ford, fortunately, I guess this has strikes every 50 cents. Because if you don't, that may not be the case on monthly options. Okay, on monthly options. If you don't, then if you're in a situation like this, where the stock's at $12.10 and we're looking at a $13 option, say a $13 call or something, that's actually a long ways away. 90 cents is a long ways away for a $12.09 stock. Okay. On NVIDIA, 90 cents is practically nothing. It moves very quickly. But so it's not a problem for lower cost stocks as long as the liquidity on the options are still there. Look at your bid-ask spread. You can look at your open interest. Make sure the liquidity is there. And when you are judging things like strike prices, we'll say strike prices to start, you can use delta to try and help guide you. Remember, delta tells you how much the option is going to move in relationship to a $1 move in the stock price. But it also gives us a sense of how far out of the money it is. And so if you use delta as a guide rather than just kind of a dollar value, it may help things out. So if you're selling an option, you're saying, well, I'm willing to go out to, say, a 30 delta on it. That may make more sense than saying, oh, I just want to go out to the next strike price up. Because it may not work out, especially with lower priced stocks. With stop losses, where to use stop losses? Very often we'll use stop losses below support levels. We'll use maybe an ATR, an average true range stop, or a percentage level. That's why when we're doing stop losses, typically we're not saying just a blanket, it's $1 below support. Or we say it's a percent, we're going to look for a percentage below support. Because percentage or ATR or delta, these all kind of factor in the stock price there, the lower strike prices there. Okay. Hopefully that answers that question. So I don't see it as a problem as long as the liquidity is there and you use one of those other measures. Question from Chuck in the chat. How do I know the difference between long and short strikes? Short strikes have the negative in terms of the quantity. It doesn't matter what kind of trade you're looking at. It can be a butterfly, it can be a vertical, it can be whatever. If you have a negative quantity there, that's your short strikes. Long, positive number there. Okay, I have one more question to answer and then we're going to be done. The last question is on it can be difficult to get out if it's less than 5 cents. Yes, it can be difficult to buy back unless it's 5 cents. Number one, in this case, you probably have to go one leg at a time. We already talked about that with these multi-leg options of maybe not getting out of the whole shebang at once, maybe doing verticals, maybe doing one leg at a time. You probably have very little chance of getting filled on these really low-priced options unless you do go one leg at a time. That's absolutely true. Even with that, it is still possible you may not be able to get out. It may not be the end of the world, okay? It may not be the end of the world because if it's that low price and you're trying to sell it, number one, you're not getting any value out of it anyway. And then if the price goes up, then you'll be able to sell it for a higher price, presumably. So, but you're right. Sometimes it can be more difficult to get some of these legs filled, especially if that option is 5 cents or less there. All right, everybody. Thank you very much for joining me. Thank you, Connie, for helping me out in the chat and answering those questions. I appreciate you. I appreciate your questions, your participation, everybody, and you joining me. Coming up next, we have trading price patterns. Make sure you subscribe to that Trader Talks channel. And that's it. We'll see you all same time next week. Have a great day, everybody. Bye-bye.